the right time. All right. Thank you everyone for joining. Good to have you guys here. My name is Ibrahim Ismail. My colleague Carl Sussin will both be leading this presentation for you. We'll be talking about the employer retention credit, of course, and how you can properly claim it and make sure you're doing it in the correct way and avoiding any of the major pitfalls that companies might fall into.
Mm-hmm.
A quick background on Leyton. Both myself and Carl are employees at Leyton. We've been here for a number of years. Leyton is an international consulting firm. We're located in about 13 different countries. We serve over 65 different industries, a total of 25 years of experience across the various countries that we're in. Our role is to be the experts in various financial incentives. We want to make sure we want to make sure we're helping your business accelerate your growth, achieve sustainable performance, have longer runway for the cash and the money that you have in hand. We hire skilled tax and technical specialists to make sure that whatever incentive, whatever benefit, whatever credit you are claiming is optimized and you're able to get as much as possible in an accurate way. Our process is always compliance first and then optimize as much as possible. And this has been our track record over 25 years in all the countries that we're in. We've claimed in the 500 million is just for the employee retention credit, including the 70 tax and technical consultants or technical experts. This is just for the employee retention credit. This is the team that we have to make sure we're able to support our clients in the best way possible. As a quick round of quick introductions, I'm based in the Boston office. I've been with Leyton for 4.5 years, and I manage the employee retention credit team. I oversee the whole product. On the delivery side, liaise with our business development side, and make sure that how we are serving our clients is in the best possible way. My background by profession is in engineering, mechanical in my undergrad, bioengineering for my PhD. And I came into Leyton working as a technical consultant on the R&D tax credit, and then have proceeded from there. It's been a pretty fantastic 4.5 years, and glad to see, hopefully see what the future will lead. I want to have my colleague and friend Carl introduce himself. Then we'll go from there.
Thanks, Ibs. Yeah, so my name is Carl. I am out of our Leyton, San Francisco office. I have been a tax attorney for about 5 years now, formerly of the Big Four, where I worked on international tax, but I brought over some of the knowledge and skill set that I had learned over there to Leyton. And I've been with the ERC group since its inception back in 2021.
To add a bit for Carl that he didn't say for himself, Carl has been really the brains of ERC. He's our primary subject matter expert. A few additional on the team right now, but he was the one that identified it as a credit that can benefit many of our clients and more, and really put the whole thing together. So he's been the big brains of the whole operation and really the subject matter expert. And a few of the case studies that we'll go in, I think will highlight Carl's knowledge in this realm and beyond. So to know what to expect from the presentation, we're going to start off with just what is ERC, how does a company qualify for it. We'll go into a bit on how to claim it and common pitfalls that you might fall into that you want to avoid. The IRS has issued a number of warnings on companies claiming the employee retention credit. We want to make sure we're highlighting that. So again, don't fall into any of those traps. We want to touch upon filing deadlines. When is the last point you can claim the employee retention credit, and a few points also related to that. We have a few case studies we want to highlight just so you're aware on what is the potential for the credit and what type of businesses or organizations can qualify. And then we'll go through a bunch of Q&As for that you guys might have. So to kick things off, what is the employee retention credit or the employee retention tax credit? This was established under the CARES Act, and it's meant as a way to bring a benefit to companies that struggled and had a hard time, a difficult time during COVID. Difficult time either because financially they incurred quite a bit of hardship, or their operations were interrupted because of government orders related to COVID. This is a credit unlike many others that we have in our US tax code. It is a refundable credit. So if you have X amount of dollars of payroll tax that you've paid in 2020 or 2021, and your credit is significantly more than that, rather than it being carried forward, it is refunded. And companies can claim up to $26,000 per employee. Specifically, this is broken down as $5,000 per employee in all of 2020. This is cumulative quarters. And then in 2021, this is up to $7,000 per employee per quarter. So in the year 2021, the maximum a company can claim is $21,000 per employee. Again, this is the maximum of $26,000 per employee. So quite a significant amount, and many companies have been able to benefit from this and recoup a very large sum of money, really helping their business. How do you know, and this is really one of the big questions to always start off with, how do you know if you qualify or not? Keep this high level right now. There's a lot of detail. ERC on the face of it is very simple and straightforward, as these slides will show, but there's a lot of nuance that comes into play. This is probably best suited in Q&A. So if you have situations, let's run through them. Let's answer questions into specifics. So first off, you are a business or nonprofit that has W-2 employees and you pay payroll tax. This is number one. Number two is how you qualify. So first, you're an eligible business or eligible organization. Then how do you make sure that you are able to actually claim during a given period? First is you're impacted by a government order, either fully where you had to suspend your operations, or partially where a portion of your business had to be suspended. Fully suspended is quite a bit easier to qualify and is very straightforward. When it comes to partial shutdowns or partial suspension, getting into the details, how much did this represent in your business? Do you hit that nominal threshold, 10%, either of revenue or of time spent, employee time spent? This is where a lot of specifics get into play. So that's one method of qualifying for a period of time. Second method is on a quarter by quarter basis. In 2020, if you had experienced a greater than 50% reduction in your revenue or gross receipts specifically compared to 2019, this qualifies you for that quarter. And it's a full quarter, not partial quarters when it comes to declining gross receipts qualification. In 2021, 20% is the threshold. So if you had a 20% or more reduction compared to that same quarter in 2019, then you qualify for that quarter. In 2021, a point to add, it's only the first 3 quarters that are eligible. If you are a new business being you were incorporated or started your operations after February 15, 2020, then you are potentially eligible for Q4 of 2021 as well. This is something Carl is going to get into a bit later with some of the changes that happened in the employee retention credit. So how to claim. I'll walk through generally how Leyton operates and how we work with our clients to make sure that we're getting all the information straight, making sure we're claiming as much as possible, as accurately as possible. Always start with a letter of engagement, whether it's with Leyton or with some other entity. Know what you're getting into, know what's entailed in the study, know what the agreements are, and so on. So we always start with a letter of engagement. We'll have a kickoff meeting with yourself, with the client and the consultant team that'll be working on their study, and run through the specifics. What does your business do? how are you impacted COVID, run through a series of due diligence questions to make sure we understand your business properly and where you may or may not qualify. You'll meet your team, the specific tax team that you're working with, and others that will supplement and support their team as well. We'll also look to gather documents that are necessary. This will be in one of the next slides. We'll gather the documents that are necessary to do the calculation properly. We'll do that internally. The consultant will do their analysis on their own, and then this will be followed up by a series of rounds of internal review. These are done by people who are experts in the field, tax attorneys, PhDs in finance. Their role is to make sure we don't miss anything, if we don't create errors. ERC is simple on the surface, but it is very nuanced. We make sure that that there's no errors or mistakes in the nuance or in the high level. Once all the work is complete and we're sure it's accurate, we provide you all the documents that are necessary to claim the credit, and some guidance on how to file the 941X. Carl's going to go into this a bit later. Mm-hmm. And then after that, you submit it, you file for the credit, and you wait for the return to come in. And then hopefully, if you enjoyed your experience with Leyton, refer a friend. And we have some incentives and some bonuses in that regard as well, if you're able to. Documents required for the employee retention credit. The quarterly P&Ls, and it's very important that it is specifically quarterly P&Ls for 2019 to 2021. We want to make sure that you're doing a quarter-to-quarter analysis and not an annual analysis. It's also not okay to take an annual P&L and then divide it by 4. That is almost never representative of how a company's quarterly revenue occurs. You will need your PPP loan forgiveness application. It's a Form 3508. There's a lot of critical information here that is necessary to make sure you're not double dipping on wages that were paid by the PPP loan and wages that you had paid your employees. On that, you will need quarterly detailed payroll reports for 2020 and 2021. This is what's used to actually calculate the dollar amount. You will want your 941, the original 941s. Make sure that everything on there is squared away and there's no potential issues or adjustments that need to be anticipated or need to be taken into account. And then additionally, regarding payroll, you'll want your employer and employee paid health benefits, again, on a quarter by quarter basis per employee. Before I pass it off to you, Carl, I just want to go and make sure if we have questions. So you want an example? So one question is, can you provide me with an example for the state of Michigan? We'll go through some examples later. I don't believe any of them are in Michigan, but we have a few that were in Michigan.
Yeah, we have a state a repository of all the different state and local government shutdown laws. And so what we have is our consultants will kind of go through those specific dates during sort of the consultation phase. Okay, so in terms of how do you claim the ERC, the IRS has specifically designed the ERC to be filled out in the 941, or now because it's sort of post 2020 and 2021, the 941X. The 941X is the quarterly payroll filing report that businesses submit to the IRS to kind of show different things like taxes paid or wages. And that's kind of also how the IRS tracks the ERC in order to make sure that a company isn't making sort of outrageous claims and kind of can back up the proof going forward. So what to include, and this is the great part of Leyton. We do all the calculations and provide you with all the sort of major numbers that are what to be included and the exact lines. Please note though that we are a consulting firm, and so we are not allowed to file for you. Some businesses may claim to be, but there's a specific rule called Circular 230 that does not allow anyone except an accounting firm to file. Now, Leyton does have partnerships with accounting firms. We can also work with your accountant to help sort of them to understand the complexities of the credit to file, or your payroll provider. But we cannot sort of fill out the form for you and then send it to you and then you mail it or mail the form for you. So what do we include in our study itself? The refundable and non-refundable portions of the tax credit, the qualified wages that are used, and qualified health plan expenses that are used. And then essentially if there's essentially a Q1, we need to also include sort of the qualified wages and qualified health expenses that are used for Q2. There's a little bit of confusion when claiming Q1 versus Q2, but we really help you out with that. And then, so one of the other sort of major parts of the ERC, and the IRS has said multiple times, you need to take account for this. A lot of companies do not tell you about this and you find out too late, but Leyton, we ensure that you are sort of well aware of this from the beginning. So the income tax amendment, just like any other type of credit that you're claiming, you cannot sort of get a double benefit. And then the way that the IRS essentially prevents this from happening is it requires businesses, so for-profit businesses like partnerships, S corporations, and C corps to reduce their salaries and wages deduction in the year that they're being claimed, because you're essentially getting a benefit already from the ERC, and so they don't want you getting sort of a double benefit in sort of reducing your taxable income by that deduction. And we kind of outlined the steps in our deliverable to kind of make things easy for your accountant or payroll provider. But we sort of give a good example here. Just under the tax rules, you can take the 100,000 of wages as a deduction, and it's essentially based on the credit. And so essentially the with the example, 300,000 of taxable income in 2020 becomes 320,000 of taxable income because of the tax credit. But once you do this income tax amendment, it essentially turns the ERC refund into tax-free, a tax-free, I guess, refund, as it kind of says. And so during, let's say that you receive the ERC in 2023, your business, as long as you did the deduction within sort of the 3 years of the requirements, does not need to put it as taxable income within your books. Now, if you're a nonprofit, you don't have to worry about that because you already don't pay taxes. Okay, we can move on to the next slide, Ebs. Yeah, so this is just kind of going a little bit further onto it. It's just reduces how much income, tax deductions reduce how much income is subject to taxes. Deductions lower your taxable income, and the ERC is not taxable income, but you are required to sort of follow that rule to make sure that it's tax-free. Now, we're going to go into sort of what I'm sure a lot of you are waiting for, is just what is the sort of the claim process like from filing the 941 up until you get your refund check from the IRS. So the file claim through the IRS, you essentially will mail the 941 to the IRS. Unfortunately, they will not tell you whether they received it or not unless you call them. But that does take some time. But generally speaking, the IRS has a process of about 20 to 30 weeks in which they review the claim. Now, please note that sometimes there are larger claims. In order to sort of ensure that there is no fraud and the IRS is getting the exact amount, larger claims do take a bit longer because they have to go through a second set of eyes, essentially, to get the green light. But the IRS, there is light at the end of the tunnel. The IRS does send companies that qualified through the ERC and filled out the form, the 941X properly, the refund amounts. Eve, you wanted to add something, I'm sure.
A quick note on here. There's something that Leyton has incorporated. A few similar businesses as us that we work with have also incorporated, is a way of tracking status of your employee retention credit claim with the IRS. This is through a form 8821. This allows a company to have visibility on your tax status. If you made an amendment, if there's outstanding taxes, if you've paid taxes, if you've made an amendment, again, on your previous tax filing, this is something that we offer in a digital fashion. So while the IRS does not tell you and won't inform you that they've received your amendment checks, your amendments, filing or signing the 8821 with Leyton allows us to be able to track that and see and make sure that they have received it. The 8821 actually gives quite a bit of visibility, and it's pretty helpful. We don't do this at any additional cost to our clients. It's just purely a value add in a way to make sure that everything's proceeding correctly and there's no major red flags. A quick point on the time frame additionally. The 20 to 30 weeks for regular claims, more than 20 weeks for larger claims. This is general time frame. It would be great if we could predict what the IRS would do, but one thing we have noticed is timing of filing the credit makes a big difference. Filing it when they're not in their peak season we've seen it tend to create a shorter turnaround time of having the amendments cleared and refund checks issued. Filing it in the middle of tax season is generally not a great idea. It's better to do it sooner than later, but those we've seen often lead to longer wait times. I'll pass back to you, Carl.
Okay. So common pitfalls in claiming the credit. The IRS requires companies to aggregate. I'm just answering a question right now from Tracy that kind of touches on that. Essentially, one thing that the IRS has released, but a lot of other companies will sometimes ignore, or sometimes they just don't know about it, is the aggregation rule requirements. And so the IRS has essentially co-opted several rules from the code, 52A, B, and 414, that require companies to aggregate if there are sort of specific connections. So are they, do they file a consolidated return? Do they have 80% or more common shareholders or board members? And so there are many specific rules where you need to aggregate companies together. Essentially, this can create sort of further pitfalls that we will sort of highlight further down in this sort of list. So,
Carl, a question for you, just to confirm, when it comes to aggregate groups, if a group of companies don't file a consolidated return, could they still need to aggregate?
Possibly. There's two specific rules that we look at. And so it's the common ownership rules under 52A and B, and the stock ownership rules. And so we have to look at either direct ownership in terms of how much company A owns company B, and that's sort of the more than 50% ownership rule, or if there is sort of common stock ownership of the top 5 shareholders between companies A, B, and let's say in this case C, we may need to aggregate. And so one thing that Leyton does is that we go through as soon as we discuss with a client and find out, hey, there may be an aggregation situation, we do a full sort of aggregation study to make sure that we're following the guidelines and rules set out by the IRS to the teeth. And essentially, if there is an aggregation situation that happens, you are required by the ERC rules to combine all gross receipts, all PPP loan information, and all wages together, and then eventually you can spread it out. But the entire study essentially has to switch to one large pot. Now, there is one sort of positive point for aggregation, and that is if one entity qualifies for government shutdown, there is a great possibility that they all could qualify. Now, there are sort of specific rules that still need to be followed within that sort of situation, but it does open up sort of additional ways to qualify. Now, going to the owners of a company, that is another sort of specific rule that was released within Notice 2021-49. And essentially, it is the owners of companies and essentially their sort of first group of essentially you can kind of think of it like mother, father, siblings, children, aunt, uncle, stepkids, and such. They cannot be included because the IRS essentially believes that they would already have been sort of taken care of. And that kind of goes to the spirit of the ERC in a way, where this credit was created to sort of keep US employees employed during the pandemic and reward companies for doing so. And so that's kind of the IRS's reasoning. Now, not everyone agrees with it. It was sort of a lot of people were complaining about it and had hoped that the IRS would remove this because it takes out a lot of sort of mom and pop shops. But at least for the time being, the IRS still has not changed that rule. Now, one great thing with Leyton is that we keep up to date with the rules. And so let's say if that rule changed, we would send emails to our clients saying, hey, this rule changed. You may actually be able to claim more credit, and we can help you do that. Now, going to confusing government recommendations and government mandates. There has been a lot of confusion in terms of specific state orders, specific local orders, and even specific federal orders. But we strongly believe that the IRS is clear that in order to qualify for a government shutdown path, you cannot use recommendations. They have to be actual sort of rules that shut down businesses, not recommending. That sort of goes to the idea of voluntary shutdown versus mandatory shutdown. And Leyton, we're very strict in terms of the government shutdown, just because the IRS has said that they are sort of doing additional scrutiny into government shutdown because there have been a lot of fraud that has happened in that case. The two last sort of rules that we take pride in making sure that we follow all the specific rules is the large employer rule. So there is no sort of hard cap in terms of the ERC, but what the IRS has and Congress provided were essentially a soft cap, and that's the large employer rules. You're supposed to look at 2019, so the year before COVID hit, and look at how many employees you had during that period of time. Now, if you had more than 100 employees, your 2020 study will need to fall under the large employer rules. And if you had more than 500 employees in 2019, your 2021 study would fall under the large employer rules. And what the large employer rules specifically require is that you can only take furloughed employees. So those are employees that are not providing services but are still retained during their furloughed period. So that just requires an additional sort of calculation to make sure that the rules are being met. And Leyton has a lot of experience with that. We have systems in place to accurately calculate that and just make sure and kind of give our clients the peace of mind that we're following the rules. And then the last one is quasi-government. So quasi-government are private entities that are essentially providing a public good. And so one of the most common ones is community hospitals. Community hospitals are established in rural and lower socioeconomic areas that are essentially paid grants by the government to sort of essentially act as sort of like a public hospital, but in sort of private control. So those are sort of the most common pitfalls that we deal with. There are many more, but we're very good at sort of issue spotting, finding those parts and then communicating them with our clients to make sure that they understand that we're following all the rules within the ERC. Okay, we can move on.
Quick note and just a reminder to everyone, if you do find that you want to delve in deeper into your business, how you guys operate, if you may or may not be eligible, our team has been putting in the chat a link to schedule a call. We'd happy to have a quick conversation. No official letter of engagement being signed. This is just a conversation to see if there's potential. If you are interested, the link is there to schedule a time.
Okay, so major changes that have happened just recently in terms of the ERC. The IRS has made the Q4 2021 recovery startup qualifications easier to meet. One of the sort of the issues that had originally occurred with the ERC and has been sort of addressed partially by the IRS are what happens to businesses that were started during the pandemic. So that's essentially the February 16th date. So any businesses that started February 16th or later, 2020 or later. And in that case, there are sort of specific rules that you can follow to qualify for the ERC, even though you didn't have any business in 2019. Another one that it's been around, but we like to sort of share that information is that companies that received a PPP loan and got it forgiven still can claim the ERC. During the inception of the ERC, this was not the case, and it created a lot of confusion. It also did not allow a lot of companies to qualify. The IRS has thus changed that rule, and now companies that received a PPP loan, got it forgiven, can still qualify. However, as we had mentioned a bit before, you still run into sort of a double benefit situation that the IRS wants to ensure doesn't happen. And so there are specific rules that you still need to follow. Leyton, we're very good at sort of following those rules and making sure that there is no sort of double dipping in case of PPP loan forgiveness and the ERC, following the IRS's rules that they have given. So certain quarters can be qualified based on previous quarters gross receipts within 2021. This is called the alternative election rule, which allows essentially companies looking at declining gross receipts to qualify using sort of a preceding quarter's gross receipts. This is only for 2021, but it gives a lot more flexibility for qualifying companies. We've had many cases where companies didn't and accountants didn't think that they qualified, but using sort of different rules, including this one, we have been able to qualify them. Q4 of 2021, severely distressed employer qualification, unfortunately, is no longer available. This was for cases where you had companies that were really, really hurting during the pandemic. However, the IRS has sort of shut down this option. And so while there were companies that we were able to claim for this, we are unfortunately not allowed to claim for Q4. So the only way you can qualify for Q4 is through the recovery startup path. For the normal companies, essentially it's Q3 of 2021 is the last quarter that they can claim for the ERC. The IRS has also sort of solidified the related individual rules. They did this back in Notice 2021-49 that just kind of laid out which individuals have to be excluded and how you look at who is technically an owner and then which individuals related to that owner must be excluded. And there are many other sort of minor changes that happen through IRS notices or sort of IRS rules that have come out, and Leyton keeps up to date on all of those. Okay. So as many of you are wondering, the IRS at the start wasn't very clear of when the ERC was ending. However, we had directly contacted the IRS and had spoken to them on several occasions to confirm that the deadlines are the ones that you can kind of see here. The SBA was also kind enough to sort of release its own sort of announcement that this is the last sort of period of time that the IRS allows to claim the ERC. And the way that you can kind of think about it is this is the 941X can only be filed up to 3 years, and sort of there's sort of an extension, and this April 15th, 2024 is that extension. So as long as you get your claim within this deadline, the IRS by law needs to accept your ERC claim. Okay. Yves, I think you can talk about this one.
So throughout since about August of 2022, the IRS had started issuing out a number of warnings for companies for different ERC pop-up shops claiming extraordinarily large ERC amounts for their clients. This is where Carl was saying the IRS is really cracking down on potentially fraudulent claims, ensuring that what is being claimed is correct, going through multiple rounds of internal review on the IRS's front. So a few things that, a few points of notice to keep in mind when you are trying to identify or trying to work with a company to claim the employee retention credit. If you don't come with Leyton, we'd love to have you, love to work with you, as we've been seeing throughout this conversation, we're very diligent to make sure we do it correct. A few things to keep in mind. Over-promising in extraordinarily large credit amounts. If a company is telling you you can max out at $26,000 per employee for both years, this is a red flag. As attractive as that sounds, you have 10 employees, you're going to make $260,000 just from that. It sounds attractive. It sounds lovely. Beware. We've worked on close to 3,000 studies, a bit more than that. If you include ones that we end up disqualifying, very, very few max out the $26,000. It's extremely rare. If a company is telling you that you're able to claim that amount, it's a very big red flag. Ignoring certain ERC guidance and rules. Now, the IRS has a number of guidances and rules online. If you start to see that some of the things are like hand waving, not giving it much importance. You own another business, but that's okay. We can do them separate. You have a PPP loan. No, that's okay. That's not important. We'll claim all. We're good to claim the wages. The IRS has said you can qualify for ERC if you claim a PPP loan. When you start having some hand waving in that regard, that's a red flag.
I just wanted to add one of the red flags that I see is that companies will essentially allow you to claim the entire year for a government shutdown. This is rarely the case. Most states had sort of specific government shutdown dates. Local and municipalities had specific dates. And according to the IRS, you can only claim the ERC for your business during those specific dates, not the entire year. And so I've seen cases where essentially ERC sort of chop shops will claim all of 2020 and 2021 using sort of bogus claims for government shutdown. We're very, very specific. We ask for specific proof. It goes through a system of sort of consultation and discussion to make sure that each claim actually can stand up to an IRS audit.
On that note, if they do not offer audit defense, don't go with them. This is something that everyone in this industry, every credible company in this industry knows is going to happen. once the deadlines end, the IRS, and they've extended the audit time frame. Correct me if I'm wrong, Carl. It's 5 years after you file the amendment, correct?
Correct. Yeah. So they look at the date that you filed the 941, and it starts a ticker of 5 years.
We expect there to be a significant number of audits regarding ERC.
Yeah.
So
And
if the company you're doing it with doesn't offer audit defense, steer away.
Yeah. And you can kind of think of it like the PPP loan, essentially, due to sort of pressures in Congress, the PPP loans were being sort of approved without sort of as much sort of looking into. And then essentially now the IRS is coming back and finding out that there was a bit more fraud in terms of the PPP loans, and people are either getting sort of arrested or essentially getting letters in the mail saying, hey, we want to sort of look at how you calculated these things.
And on audits, this is something new that we're adding and we're doing we do it automatically for our clients, but additionally for others. Carl, I'll let you cover this point though.
Yeah. So one of the great things for Leyton is we do 2 sort of rounds of quality control for every sort of written documentation that we go through in order to ensure that everything kind of would stand up to an IRS audit, because ultimately, as part of the contract, Leyton does provide audit defense of 16 hours. And what we always kind of do is we hope for the best, but plan for the worst. From sort of the entire study, we're getting everything ready in terms of if there is an IRS audit. And essentially we sort of provide that sort of additional defense. That's part of sort of latent service compared with a lot of our competitors. And it's just kind of to ensure that we are sort of the quality over sort of quantity side of things. As Ibrahim had mentioned, there is sort of that 5-year statute of limitations. If you look at sort of the Leyton contract, our audit defense goes for that 5 years. So we stay with you for that sort of 5-year period that the IRS has established. We will speak. I mean, again, this goes to us being a consulting firm. We're happy to sort of support you in sort of your contact with the IRS up until the audit, when sort of the audit defense kicks in. But that's all sort of provided as sort of additional support on, you know, why you should go with Leyton versus sort of another firm that won't help you if the IRS ever comes knocking.
And next thing we would like to go into are a few case studies of clients we've worked with, incidences that they've gone through while claiming the credit, and how they were claiming and how we did the study for them. Carl, I'll let you take care of.
Yeah.
I'll let you cover a quick response.
So this was a client that had originally been rejected. In their sort of first claim, they had gone with somebody else. They came to Leyton. We redid the study. We helped them sort of properly file it. When the IRS did have sort of questions, we provided support, and we were able, with our knowledge of the rules, we were able to start to discover additional eligible quarter through that sort of notice 2021-23 alternative election rule. And the IRS managers agreed with sort of our assessment through that. But this kind of, we put this example here to kind of show that Leyton does sort of support you throughout the entirety of your claim until you get your check, and even past that with the audit defense.
This was an interesting client that we worked on. This is a nonprofit education organization. It's called Atlas Foundation for Autism. They qualify through a suspension of service through a government shutdown in Q1, Q2, and Q3, partially in Q3. It was in the full quarter of 2020. But they did not qualify through a decline in gross receipts. Their suspension of service was through a partial suspension. So they could still operate in a remote capacity. But what they were not able to do was various activities they did with their students, whether it was after school, after proper school time activities, in-person activities, sports, etc., other clubs that they would do. All those they were incapable of running, and they also represented a portion of their revenue. That represented more than 10% of their total revenue in 2019. And because of that, they were able to qualify through the suspension of services qualification, the government shutdown qualification during this time period. They had a total of 25 employees during these quarters, approximately 25 employees. And again, it was only 2020 that they qualified for. They had a PPP loan of about $210,000 that reduced the total credit they could be eligible for. But at the end of the day, they ended up receiving $117,000, just over $117,000. And this was something that they had said for on our behalf regarding working with us. Working with Leyton has allowed them to take advantage of the ERC, in which they plan to allocate funds towards staffing, general operations, and program funding. Honestly, it's what we'd love to hear. Another organization that we worked with, a religious organization in this regard, they're called the Adams Center. They both do education, religious services, humanitarian aid. They have a lot of supplementary services that they do that falls under their umbrella. They qualified through a decline in gross receipts in 2021. This is where they had a greater than 20%, greater than or equal to a 20% reduction of their gross receipts in Q1, Q2, Q3, compared to the respective quarters in 2019. They had about 160 employees throughout this period, and they did not have any PPP loan. Their credit amount was around $915,000. And Carl, I'll let you cover this one.
So Lark Hotel chain, for those in the sort of New England area, they have quite a few hotels within sort of that region. They were sort of one of our original studies that we've had a good working relationship with, even after we got them the credit. And so what was interesting there was that they qualified for certain periods of time, either through declining gross receipts or through government shutdown path. The IRS allows you to essentially qualify each quarter as government shutdown or as declining gross receipts. And you can have a sort of a mixture of both. Sort of an example there was in this particular case, they had a declining gross receipts in Q1, Q2, Q3, and Q4 of 2020. But they didn't qualify in Q1. However, they did follow the government shutdown orders in Q1. And so we were essentially able to qualify them for the whole year for 2020 based on sort of a combination of both rules. Another sort of interesting thing is that they had sort of a shifting employee base based on sort of seasonal, sort of hours. So they had about 70 active employees during their peak periods in summer. Unfortunately, that was sort of the height of COVID. And so their number of employees that were affected was far greater during that period. In the winter, of course, they're sort of on a skeleton crew. So they had 40 employees. But again, you know, there are sort of specific rules that we can look at to get them the most accurate credit. And so even though they had a large PPP loan, we were still able to identify and get them a much larger credit than they had originally believed was possible.
And just to run through a few other quick examples on high level without going through specifics, we have a telecommunication company, 38 employees. Their credit was 550,000. We had a brewery company that claimed 220,000. Parking services company, 435,000. utility contracting company, 21 employees. They qualified for a large portion of time. They got 355,000. Now there's a healthcare organization, large employer, 390 employees, but they were still able to claim 435,000. There was an educational high school, received 1.4 million. Summer camp received 270,000, and another hotel that received 300,000.
And all of these, oh, sorry, you can go first, Eebs.
I say this just to give a few examples on different types of organizations and companies that really are eligible for the credit, and some different amounts that they're able to claim.
Yeah, and these are all clients who received their checks in the mail already. And so just kind of showing the IRS will sort of uphold the sort of claims that they are asking for. They do ask, especially for the larger claims, additional sort of documentation and support, but Leyton is happy to provide that going forward.
And that's the end of our presentation. I know there've been a bunch of questions that came through the chat throughout that we're answering, but really happy to take any of the questions that anyone has. If there's any specifics that you'd like to chat about. Again, if you really want to dive in deep into the specifics of your business or your operation, your organization, happy to have a call with you, myself, Carl, someone from my team. Please go to the link. We also have the link in the chat. Schedule just a period of time and we'll hop on a call and go through some specifics. Really do a high level understanding if you would qualify or not for the credit.
Yep.
And there we have the link one more time. So a question says, has anyone received a letter saying the IRS made an error processing the claim? From our experience, not exactly like this, but Carl, I'll let you touch on a couple of situations that might be similar to this. That you
Yeah, so in the cases that we have run into, the IRS will usually what happens is sort of one of two scenarios where either the client essentially didn't fill out the form as we had advised them. One of the things that the IRS looks for is that the numbers all sort of make sense on their end. So qualified wages, healthcare needs to equal the credit amount multiplied by the credit percentage. And so if those numbers don't add up, that case could be rejected by the IRS. There's also cases where if a client has not filed the original 941, they are not allowed to claim the ERC until they file that 941. And then there's a lot of confusion with Q1 of 2020 that you are required to include it within the Q2 form. We do have a lot of instructions for that particular case. And then the last one is if a client didn't realize they were part of a PEO. Part of another sort of subset of rules is that if you are part of a PEO, you need to claim it through the PEO. There are specific sort of additional steps, but they're within the laws of the ERC. You are still protected, so that PEO cannot just take your credit; they have to give it to you. So those are generally speaking the sort of processing errors that we have run into, except for like very, very rare cases where there is sort of a mistake made either by the IRS or the payroll company. But in terms of sort of providing you the exact numbers and sort of documentation that you need, we're very good here at Leyton at doing that.
Does that answer your question, Darcy, or do you have a follow-up on that?
Can you hear me?
Yes, we can.
Oh, hi. We actually got a second letter saying that the IRS made a mistake, like taking back the first letter. And then we got a check the next day. And then the second IRS mistake that we found is they were off by one. Like we were supposed to receive 185,000 and we got 18,500. So we had to file another letter saying they made a mistake.
Mm-hmm.
And as that happened,
We haven't had that happen. We've had instances where, like Carl was saying, where the IRS will either reject a claim or say that the company is only allowed an X amount. We'll
Mhm.
typically call the IRS along with the client to get clarity and to answer any questions on the spot. Carl's had an incident where this happened with a client, and then with quick response that you mentioned earlier, and just on the call corrected it.
Mhm.
Kind of nice that they caught it on their end and then corrected it for you.
Right.
But as a general statement, like if it happens where you receive an amount that isn't correct and is not what you filed,
Mhm.
I would call the IRS.
Yeah.
Yeah.
Uh,
And
this is just for, go
did we
ahead.
miss the part on how much Leyton charges for this service? Is it a percentage or is it a flat fee or hourly fee?
So we will generally charge a % fee. The specific amount or the specific percent is something we'll discuss with each company individually.
Okay.
Some companies, based on their situation, will want to have different arrangements, whether it's a portion is %, a portion is fixed. So we have that discussion on a case-by-case basis.
And in timing of the payments as well.
Okay.
Any other questions?
Oh,
One-
can I have one
Yeah,
more?
of course, Darcy.
Sorry.
No worries.
You had mentioned with the government data, like the database of the government mandates, does it mean that you have like a file, like say we're in Palm Beach County in Boca Raton? Would you be able to type in Boca Raton and see what restrictions were placed on like a restaurant or a bar?
So we have it's for our database, it's internal.
Mhm.
It's a lot of sort of valuable data where we've basically, for every study that we've done, we've kept all the sort of state laws, local laws, and sort of kept it just so if we ever run into a similar case, we're able to our consultants are able to quickly find out, okay, this is what happened in this situation, this is the rules that we used, how can I apply this to my case?
Okay, thank you.
Of course. A quick note, something that you mentioned, Darcy, that kind of prompted a thought in my mind. If a company is claiming multiple quarters, what we've seen as a trend from the IRS is that they process each quarter individually. So say you claimed 3 quarters in 2021 and you only received a check for Q2. This
Mhm.
doesn't mean that the other 2 are rejected. It just means that they're still in processing.
Right, and that's been our experience. We've received 1 letter for each quarter. Just
Yeah.
happened they made a mistake on 2 quarters. So
Any other questions before we wrap up for today? And we are always available. We have our US marketing team's email down below. We have a link in the chat. Happy to get into any details with any of you. Or if you have friends, other businesses that you know that you would like to refer or have a chat with us, more than happy to at any time. All right, I think with that, we'll wrap up. Thank you all for joining.
Thank you for joining us.
Having you, and I hope we get to speak in the future. Take care, everyone.
Bye.